But time now to get in touch with Manishi Raychaudhuri. He's joining us. He's a veteran investor in Asian equities. And Manishi, hi, good morning. Thanks so much for joining us. First up, I want to get a broad sense from you on where you believe the Indian markets are headed. We've had a lot of news flow in terms of, let's say, the FTA, tariffs, FII buying and selling that's been happening ever since we last interacted with you. A lot has changed for the market construct. Do you continue to remain bullish on the markets, and what's your outlook for the rest of this year for our Indian markets?
Great. Thank you very much. And thanks for having me on this show. If we take a step back and look at, around the first or second week of April, when we first had the Liberation Day tariffs and a rollback of those tariffs or a postponement on 9th of April, since then, Indian markets and entire Asian markets have had a solid run. They've moved up almost, I think, anywhere between 10 to 15%, because depending on which market you look at. And after that, I think it is time for the Indian market in the near term to take a breather. And that's exactly what we are seeing. Not only have the markets run up very sharply over a short span of time, we're also seeing valuations which are close to about 50 to 55% higher than the Asia ex Japan average in terms of forward PE multiples, and more than 100% higher in terms of forward price to book multiples. And these averages, if you look at the past 15 years, are usually about 40% and close to 60% respectively. So it's way higher than the long-term average. I think investors are beginning to, understand that. Second, and possibly more importantly, we're also seeing earnings estimates continue to come down during this just concluded result season. We are in the last few days of it. The consensus EPS estimates for India, both for fiscal 26 and fiscal 27, they're down about 5 to 6%. So I think these are the things which are kind of playing in the mind of investors right now. It's not something to be too worried about over the longer term, because we are now seeing some of the green shoots emerge in terms of consumption potentially coming back, even government spending on infrastructure coming back, even interest rates they have begun to be cut, and with the very benign inflation environment, we are going to have that kind of a situation in the foreseeable time horizon. So long term looks fine. Short term, I think the market would take a breather, maybe a bit of a time correction from now.
And Manishi, how do you suppose global equity inflows are going to move? And I want to talk about the Far East and West, both to India. Given that Japan's long bond warning has been issued, we've seen how their long-term borrowing costs have hit a record high because of demand fears, and tariffs are finally sort of biting the economic data points as well. Where do you think the money flow is going to move in the developed world, within emerging markets? How do you think the next few months are going to pan out?
Great question. I mean, over the last few months, right from, I think, the second half of 2024 and the first quarter of 2025, we had this sell emerging markets by United States, this trade going on. Now, I think we're seeing over the past couple of months a reversal of that trade for justifiable reasons. There's a lack of confidence as far as the US markets are concerned. It's partly because of the uneven or, this unsettled policy environment that we're seeing over there. And as a consequence of much higher inflation expectations, we have also seen bond yields move up, which means that the US bonds, US treasuries, which are theoretically and historically being seen as a safe haven investment, they're being sold down and sold down quite badly. So I think this trend for now is likely to continue. We are seeing money move into emerging markets, and particularly Asia Pacific. Anyway, Asia is about 80% of emerging markets. As of now, the big gainers have been North Asia, which is Hong Kong, China, partly Korea of late, and to some extent Taiwan. Flows have improved in India as well. from late April, but they still remain volatile on a day-to-day basis. But I would think that if the present situation continues, which is growth estimates being revised down in the United States and inflation estimates being revised up, which leads to bond yields remaining high over there, then this present flow trend that we are seeing, flows coming out of developed markets into emerging markets, would continue for now.
Hi Manishi, good morning. This is Shrishti also joining in. So I was just wanted to have your view on the FIIs, and you just highlighted the fact that the FIIs, the number actually is quite volatile on a day-to-day basis, but some improvement indeed there. But in terms of the sectors, Manishi, which sectors do you believe are expected to do well? Give us some sense there, because the last time you connected with us, you did talk about the financial space, how the pharma space is picking up, and along with that, the IT that is still underway, going some of the kind of news flow that is impacting from the US markets in terms of discretionary spending. Give us some sense that within sectors, what are your preferred bets?
Great. So, we continue to prefer the private sector banks in India because if we do have a rebound in consumption and investments, that would have to be financed by the banking sector largely. And within the banking sector, the private sector banks are gaining market share. They have way better technological platforms and much better asset quality on their balance sheets. We're also positive on the consumer discretionaries. We're gradually seeing, the effect of tax cuts. Going forward, we're going to see the impact of more money in the hands of the government workers. And the third thing would possibly be industrials as a consequence of the infrastructure spending coming back. And I would possibly include some of the defense equipment manufacturers in this same bracket. So these are the three, buckets, three silos that we're positive on. I would also briefly talk about healthcare. I think, there's a lot of uncertainty about the generics manufacturers, but if you look at domestic healthcare, particularly the hospital and diagnostic chains, I think the impact of increased urban affluence would flow through to that sector as well.
Okay, Manishi, so that's your take on the sectors you're liking right now. I also want to get your quick take on crude and crude beneficiaries. We've seen a little bit of a jump up coming in WTI and Brent. Give us a sense of what you are making of some of these crude beneficiary sectors like paints or aviation. What's your outlook on these lines?
Right. The problem with some of these sectors that you talked about, paints, for example, if you want to play the market leaders, and that is basically the strategy that we're adopting, the market leaders which have pricing power. In this sector, the market leaders are, very highly, very expensively priced. There's hardly any margin of error. Aviation is something that we like because, there's an impact of better domestic consumption and money flowing into the hands of the population, which would have a rub-off effect in the entire tourism sector. We do have kind of a benign oligopolistic, environment over there. In all these sectors, investors would have to be very careful about the valuations they pay. That is the kind of final message I would like to leave with our viewers.
All right, Manishi, also the last time you connected, you did believe that gold is one of those assets which could actually witness some bit of a correction. Give us some sense there that what's your current outlook on gold?
Right. So that correction, in a sense, in a small way, seems to be happening now. But ultimately, I think the global central bank's preference for gold will likely continue. We have had a situation where there's a degree of, I wouldn't say aversion, but a degree of caution about owning US dollar assets, even US treasuries. And we have seen that on the part of China and that's partly because of the kind of geopolitical tensions that we're seeing all across the world. I think, despite the fact that there are bilateral discussions that are happening between the US and China and between US and other countries, this caution about US dollar is likely to stay for now. And the only alternative that most of the central banks have is gold, and possibly some other bullion, but predominantly gold. So I think, over the longer term, I would still remain positive on gold. Investors would obviously have to bear with this short-term volatility that they're seeing in bullion prices.
Okay, Manishi, interesting times we live in. Good to have you on the show and good to gather in your perspective as always.